The inflation report came out this week. Every major outlet called it expected. Most investors moved on within minutes. But one number buried inside that report tells a completely different story. And it has nothing to do with the Fed. It has everything to do with how you are spending your money. The PCE report, that stands for Personal Consumption Expenditures, landed this week. It is the Federal Reserve's preferred way of measuring inflation, not the CPI number you usually hear about, this one. And on the surface, it looked fine. Annual gains came in as expected. Markets did not panic. Yields moved slightly. Most people stopped reading right there. But the detail that actually matters is something called supercore inflation. The official term is core PCE services, ex housing and energy. It strips out food, energy, and housing costs. What you are left with is the inflation inside everyday services. Haircuts, healthcare visits, restaurant meals, subscription services, professional fees, the things people actually pay for every single month. And that number is running at 3.9% annually right now. That is not mild, that is structurally sticky inflation. It means the cost of living your daily life is rising faster than most people's wages keep up with. So let me ask you something. When was the last time you noticed your grocery bill was fine, but everything else still felt more expensive? That is exactly what this data is showing. The things you buy once at a store are stabilizing. The services you pay for on a recurring basis are still climbing, and that distinction matters enormously. Not just for the Fed's rate decisions, but for how you should be thinking about your money right now. Here is the question most people do not ask. If service inflation is running near 4%, who is actually collecting that money? Because inflation is not just a loss for consumers, it is simultaneously revenue for someone else. When you pay more for a streaming service that keeps raising prices, that revenue flows somewhere. When healthcare costs rise faster than overall inflation, that money lands on a balance sheet. When restaurant meals become noticeably more expensive and people keep going, that margin improvement shows up in earnings. This is where the PCE data stops being just a macro story and starts becoming a practical investing framework. Charles Schwab's research team noted something important this week alongside the PCE release. Oil prices have dropped substantially over recent weeks. That gives the Fed breathing room to stay patient on rate decisions. But patience from the Fed does not mean the inflation underneath the surface has gone away. It means the Fed is watching and waiting. The Fed's new chair, Kevin Warsh, has set up a committee specifically to provide new guidance on inflation metrics. That tells you something important. The old framework for reading inflation is being questioned at the highest level, and the markets that depend on rate clarity, bonds, growth stocks, real estate, are all waiting for signals that have not fully arrived yet. Hold that thought. Because what consumers are doing right now in response to this environment is just as interesting as what the Fed is doing. If you are finding this useful, consider subscribing for more practical financial insights. There is a behavioral shift happening inside the spending data. When persistent service inflation runs alongside falling energy prices, consumer psychology splits. People feel relief at the gas pump. Brent crude has dropped significantly in recent weeks. The U.S.-Iran ceasefire agreement helped push oil prices down sharply. Lower fuel costs feel like a win, and that feeling of relief, even when it is just at the pump, tends to loosen spending elsewhere. People do not consciously think about it, but the research is consistent. When energy costs fall, discretionary spending often ticks upward, not dramatically, but enough to show up in retail data, enough to show up in restaurant traffic, enough to show up in travel bookings. The problem is that relief spending flows into exactly the service categories where inflation is already running hot. So the consumer ends up feeling better in one pocket while spending more from another, and the economy absorbs all of it. Now here is where this gets genuinely interesting. Markets. Schwab also noted this week that the focus over the next few days could shift away from tech. Thursday's non-farm payrolls report lands a day early, moved ahead of the July 4th holiday. That jobs report will tell us whether the labor market is still strong enough to sustain this level of service spending. If jobs are resilient and service spending holds up, the companies collecting those service dollars are in a strong position. If the jobs report surprises to the downside, spending contracts fast. And that second scenario would hit consumer-facing services harder than almost any other sector. So let me break down what this means in practical terms. There are really three types of investors watching this data right now. The first group sees the PCE number and moves on. They are waiting for the Fed to cut rates before making any major decisions. They are sitting in cash or short-duration bonds. That is a reasonable position. but it carries its own risk. The window for rate cuts keeps shifting. The second group sees the service inflation signal and starts asking where that inflation is actually going. Healthcare services, financial services, insurance premiums, subscription platforms. These are areas where companies have demonstrated consistent pricing power. The ability to raise prices without losing customers is one of the most valuable things a business can have in a sticky inflation environment. The third group, and this is the smaller, more patient group, is watching the combination of falling energy prices and resilient consumer spending. They understand that cheap energy is essentially a tax cut for middle-income households. Every dollar not spent at the pump is a dollar potentially redirected somewhere else, and that redirection tends to benefit the mid-market consumer economy, not just luxury, not just survival spending, the in-between, where most people actually live. The PCE report this week did not make dramatic headlines. It was not supposed to, but it confirmed something that has been building quietly for months. The American consumer is under real pressure from services. They are getting temporary relief from energy, and the economy is finding a fragile equilibrium between those two forces. What that equilibrium looks like in 6 months, especially after Thursday's jobs numbers, will tell us more about the second half of 2026 than almost any Fed speech could. The data is always more honest than the commentary. That is what the numbers are showing right now. What you do with that information is up to you.